This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
I want to talk a little bit about what's going on with Apple. It's pretty much the biggest tech story out there. The company, just days away from a U.S. ban of its smartwatches, is plotting a rescue mission for the $17 billion business that includes software fixes and other potential workarounds. Here's what's going on. You got engineers at the company are racing to make changes to algorithms on these Apple Watches that measure a user's blood oxygen level. Now, you'll recall from our coverage yesterday that this is a feature that Masimo Corp has argued infringes its patents. Apple engineers are adjusting how the tech determines oxygen saturation and presents the data to customers. This according to people familiar with the work. That reporting from our next guest, Mark Gurman. He's Chief Technology Correspondent for Bloomberg News. He joins us on Zoom from Los Angeles. Mark, you've been all over this story over the past couple of days. Where are we at just after 4 o'clock here on the East Coast?
Yeah, thanks, Tim, for having me. We are in the same place we were yesterday. We were in the same place we were when this a ban was announced back in October by the ITC, the International Trade Commission. There's been no movement. It doesn't appear that the Biden administration or the U.S. Trade Representative, Katherine, is any closer to vetoing. There does not appear to be any imminent settlement between Apple and Masimo. And Apple is probably at least several weeks away from being able to deploy that software fix we talked about. And it's also unclear if the software fix will even be approved. The U.S. Customs Agency, which monitors what's being imported and exported into the U.S., they have to approve this fix. And if they don't believe, or if Masimo provides good evidence that the software fix does not fix the patent issue, we can be in this issue for the long haul between Apple and Masimo.
Well, one thing that I learned from your reporting today was the fact that Apple engineers are working on this this update to the software, which came as a surprise to me, Mark, because I thought this was a hardware issue, not a software issue. I thought this was about a sensor that's on the watch, not about software that powers the sensor. So give us the details there.
You're absolutely right. It's nothing to do with software. This is a hardware issue. The patents in question relate specifically to the arrangement and the back-end technologies and LED lights. At the bottom of the Apple Watch, there's a special red light that shines through the bottom of the watch to non-invasively go into your skin and read how much oxygen is in your blood. And that's the patents that Masimo holds. These are the patents that are being disputed right now that Apple has infringed upon. So it is a software issue, but the way it has been explained to me by people who are involved in patent law and in the patent world, not from Apple or Masimo, is that technically that hardware could be disabled and is controlled by the software. So that might be a workaround until Apple is able to shift the actual hardware in the Apple Watch casing in a subsequent generation. And that is likely what Apple is banking on, because needing to redesign the entire watch hardware plus those algorithms, that could be a several-month process. And quite honestly, it would be a big money loser for Apple compared to probably the few $100 million it would need to pay out. Masimo, my take is that Apple sees that money from Masimo as some sort of ransom. They don't want to set the precedent of, paying out what they consider to be a patent troll. Masimo and many others believe that they're in the right here. Clearly, the ITC has seen a lot of cases, and given all of their experience, they still sided with Masimo. So there's probably a lot going on here in Masimo's favor.
So you write that they plan to stop selling the prohibited watches on their website on Thursday and then pull all of them from their roughly 270 brick and mortar Apple outlets by December 24th. I mean, how much is this going to hit Apple's profits ahead of the holiday season? I imagine there were a lot of people who were planning on last minute scooping up these watches.
I'm sure a lot of people who wanted to get Apple Watches for the holiday season, they already did their shopping. The news is out. If you want an Apple Watch for Christmas, you have to get it before Christmas, right? People probably aren't doing their Christmas shopping on December 26th when Apple retail stores are going to reopen because they're closed on the 25th anyways. Right. So I don't think that this is going to impact Apple's revenue for the first quarter. I think this is going to impact Apple's revenue probably for the second and third quarter. And given that this is US only, and it's only within Apple's first-party retail channels, My guess is that this is a $1 to $2 billion headwind at most. But of course, that shifts dramatically depending on how long this is going to take, right? My assumption is that this is resolved by the second or third quarter. There is a universe in which Apple is going to court after court case, that they're appealing to the ITC, they're appealing to the customs agency, the White House, trying to settle with Masimo. So you can't put an end date on this. So you really can't know how this is going to shake out. But, I would guess probably a couple billion if all goes well to Apple's side.
Explain to me, Mark, and you mentioned that this is happening. Like if you want an Apple Watch, one of these new Apple Watches after December 25th, then you can go to Best Buy. You can go to other retail outlets. Like, because as you said, these aren't being sold. These aren't being banned at Walmart and Best Buy. Why is it only applying to Apple's own channels?
Yeah, and in addition to Best Buy and Target and Walmart and Amazon, the carrier stores sell them too. So you can get an Apple Watch at Verizon, AT&T, T-Mobile, you name it. And I would imagine the vast majority of Apple's products are sold outside, right, of their 270 retail stores in the US, maybe outside even of the online store. That's certainly the case for iPhones, and it might be for Apple Watches as well, given the attachment rate. But that Apple's working with the letter of the law here. So Apple's perspective is that the order, which is two-part. One is the import ban. Two is the cease and desist on sales. The cease and desist on sales from the ITC specifically says Apple, right? So that means Best Buy and whomever can keep going. Massimo lawyers, who I spoke to yesterday, believe that Apple should be instructing the third-party retailers, given they're partners of Apple, to stop. Obviously, it would be in Apple's best interest to not do that. But as I wrote earlier today, Apple retail employees and customer service reps can't legally point people towards Best Buy at all to continue to buy their Apple Watches. So it's going to be really interesting to see how this plays out. We can get news any minute now that Biden has stepped in and this ban is no longer happening. Or we can get news in 2 months from now that there was a settlement, or Apple could put out a software update in a month that rectifies everything. So we'll be holding our breath to see what's going on.
And Mark, we certainly know that you'll be all over the story, just like you've been all over the story over the last couple of days. Mark Gurman is Chief Technology Correspondent for Bloomberg News, joining us on Zoom from Los Angeles.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Shares of FedEx down by 7.5%. The company reporting profit below analyst expectations. Cost cuts were not enough to make up for volume declines at the air freight and trucking units amid a lingering cargo recession. The company also lowered its sales forecast for the fiscal year that ends May 31st. Joining us now is Lee Klaskow, Bloomberg Intelligence Senior Transportation Analyst. He's here in the Bloomberg newsroom this afternoon. Lee, good to have you with us. You've had about a half hour to dig through these earnings. What sticks out to you? Because at least in the beginning of the after-hours session, investors are not so fond of it.
Yeah, I think the good news here is that they reaffirmed their adjusted earning expectations of 17 to 18.50 a share, which is kind of in line with where consensus is, even though they're lowering their revenue outlook. And that shows me that they're actually making some progress with their Drive initiatives and their Network 2.0 initiatives, which are really a way of them just to reduce costs and increase productivity. I think you're really seeing that on the ground. Their ground business margins improved over 300% year over year. I think that you probably could see further improvement as volumes come back stronger when the economy, I guess, normalizes, whenever that's going to happen. But it definitely is a mixed bag. FedEx Freight showed better volume while ground did not. And that, to me, is indicating that the share that they won from Yellow, when Yellow went out of business, that was a large LTL carrier that went out of business in July, that business was sticky, whereas the business that they won from UPS, when UPS was dealing with their labor negotiations, was not as sticky because volume was about 50 basis points, at least the growth was 50 basis points lower than expectations. So I think that's what we're looking at in Express. The margins were just not good. They were about 1.3%, trying to figure out what's really going on there. But on the surface, they were down a lot more than expectations.
So with the stock down about 8% in the pre-market, do you think this is an overreaction in terms of the investors right now? Or the post-market, excuse me, not the pre-market?
Well, you have to remember the stock's up, I'm going to give you a round number, 65% before today. So it's had a heck of a year, if you will. So maybe some of that fuel is coming out of the engine or the air out of the balloon, if you will. But, FedEx has a history of, disappointing. And then coming back. And so it's about management showing that despite the numbers, they are executing. And I think they will be able to do that because, again, they're still going to take out about $1.8 billion in permanent costs through their Drive initiative. And so that's worth noting. That's more than a couple coins under the couch.
Is there any commentary or anything that we can read into, Lee, when it comes to the health of the U.S. consumer or the U.S. or global economy here? Because I'm reading through the write-through by our own Thomas Black, who covers the company for Bloomberg News, and it talks about consumers are returning to stores, they're contending with inflation, with higher interest rates, buying power is dented here. What are your takeaways about the consumer when it comes to these numbers?
I mean, listen, at the end of the day, parcel carriers like FedEx or UPS or DHL, they're still going through a process of normalization, and that normalization is on the demand side. We're not there yet. Destocking in the U.S. seems to have run its course, which is a net positive. I think the commentary that management's going to provide on the call shortly will give us more insights into peak season, because this quarter ends at the end of November. So you get a little bit of maybe holiday buying in those numbers, but I think they're going to be able to provide us a little more insight into where the consumer is on the call, which is a couple minutes away.
Okay, so we haven't had the call yet, but Raj Subramanian took over as CEO from founder Fred Smith in June of last year. Is there anything that you get from this earnings report that tells you about this new CEO and his performance?
Well, they brought in some outside people, I think, which is a net positive. So maybe some outside perspective is a good thing for a company that might have been a little too insular for too long of a time. And one might argue that over the years, FedEx has gotten a little quote unquote fat. And that's kind of why they're doing this Network 2.0 and Drive initiative. Between the two of them, they're going to reduce costs by $6 billion. Some of those costs will be permanent. The Network 2.0, what they're looking at is taking their express networks and their ground networks and maybe finding synergies between the two. They operate a very different network than someone like UPS, which kind of operates one big network, where FedEx has two separate networks. And that's because their ground business, the trucks that come to your house, they're independent contractors, where in UPS, they're employee drivers. So it's a very different model, and they're trying to change with the times and trying to become, like I said, a more efficient organization. And looking at the ground margins improving by over 300 basis points, I think they're making some incremental progress. I think the reality is that maybe the street got ahead of itself on the name.
I'm pulling up shares of UPS right now. In the after hours, Lee, the company's stock is moving lower, as Charlie mentioned, right now by about 1.75%. Can we read into these results and have any takeaways for UPS here, even though these are different businesses?
Right, they're different businesses. And again, what I would say is that I don't really know that we have full temperature of the consumer just based on the numbers. We have to hear more from management. That's interesting, yeah. Hear what their customers are saying. Kind of where their end markets are heading. I think a lot of people will want to know, because last quarter they were very optimistic about how sticky some of this UPS business was. It'd be very interesting to see if they remain optimistic about that business. And again, it's about their journey of lowering their costs and becoming a more efficient network. And that's not going to happen overnight. You have to give management a little slack from quarter to quarter to try to execute on that. Because the reality is, as you know, whether it's things going on in the Red Sea, whether it's strikes, supply chains tend to get dislocated a lot over the last 36 months. And we expect those challenges to continue. And FedEx's and the UPS's of the world have to kind of adapt to those changes.
Lee, we're going to let you go because you got a earnings call to get on, and we really appreciate you joining us on this. That's Lee Klaskow. He's a Bloomberg Intelligence Senior Transportation and Logistics Analyst joining us here in New York. This is Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, it is the most read story on the Bloomberg terminal in the last 8 hours. Actually, the most read in the last 24 hours. And it's not great news for folks on Wall Street. Wall Street's dramatic shift, or year of deal making, I should say. There was a drought, collapsing banks we saw job cuts. It ended, and it could end, with a mere whimper for traders' bonuses. At JP Morgan Chase, for example, the overall bonus pool for its legions of traders will be close to flat compared with 2022. That's according to a person familiar with the matter. That's similar to Citigroup in the midst of its biggest restructuring in decades, where the pool will likely be little changed, if not slightly down, another person said, asking not to be identified, discussing private information. Those words, courtesy of Katherine Doherty and Hannah Levitt, they're both finance reporters for Bloomberg News, and they wrote this story. They're both here in the Bloomberg Interactive Brokers studio. Kat, I want to start with you. It's interesting because you look at what equities have done this year, especially toward the end of the year, and we've seen this massive rally. So if you're an investor who's, been long the markets, you're having a pretty good year. If you work on Wall Street, though, it's not looking so good.
Well, it depends where you sit. I would say trading overall, so fixed income, equities, the more volatile periods that you have, the more money that you're making, because you're not taking positions, you're not making bets like the buy side, what you would be referencing, but you're executing those trades on behalf of those investors that are making the bets. So in a period like this, you are right. The end of the year is always more volatile, up or down. If traders are making more trades, they're making more money. Also, the bigger the trades, the more money you're going to make. So you're taking fees, and those fees are going to increase. Likely in the fourth quarter, you're going to see that up compared to, let's say, the third quarter that would include the summer months. So we're really comparing the entire year, though. And 2023, we've had ups and downs. And it's compared to last year, which was a really disappointing year across Wall Street for bonuses. If you were an investment banker, a trader, you name it. And that's because we were comparing it to the year before. So you always have to think about the perspective. And the year before was that boom year. That was when money was flowing and deals were every day was a new M&A announced, and so those investment bankers were making money, traders were making money. So you really have to think about each year in a silo. This year, it's very tepid. It's very warm, I would say. No one's crushing it, but no one's getting crushed either.
Hannah, can you give us a sense for those who don't work on Wall Street and don't maybe get those bonuses? How big of a deal is it to come to the end of the year for these people in these industries to actually get the news of what their bonus is going to be? I guess culturally, but also just as a part of employee well-being.
Yeah, it's a huge deal. These employees, these bankers and traders get, a large portion of their comp. It can be more than their salary and bonus. So that's really, when you're looking at how much you're going to make in a given year, how much you made in that year, bonus plays a huge part of it. And so that's what drives the morale, up, down, or lukewarm, as Kat said.
So I mentioned JP Morgan Chase, Hannah. I mentioned Citigroup. There's also Goldman Sachs, Bank of America. What did you guys learn about those companies?
Yeah, so Goldman and B of A could both be increasing bonuses for traders up a couple percentage points this year. And, to dig into those, you get a sense for the story at each of those firms. So B of A has made some gains this year in market share compared to peers in trading. And so that will likely be reflected there. And then Goldman last year, they had this really expensive foray into consumer banking that they then, have pulled back from. And so traders were hit especially hard last year, as they were dealing with the expense of that. So there's some room to grow for Goldman as well.
What about specifically in Bank of America? Because we had the CEO saying that they're going to be devoting more capital to trading and I believe also increasing hiring. What specifically is different about Bank of America that has led to growth that we're actually not seeing at the other banks?
Yeah, I'm going to kick that one to Cato because
he didn't mention hiring necessarily. He did mention capital, and this is not new. Over the past few years, the bank has dedicated more capital, and for trading, that specifically just means this is more money that they have, more of the balance sheet. Bank of America has this large balance sheet because they're not just the investment bank, they're not just trading, they serve consumers as well. They have the consumer bank and the commercial bank. So when you have a bigger balance sheet, it's similar to JP Morgan. You can essentially do more trading if you have a client that you're serving. Maybe it's a small business. That balance sheet is going to expand. You're going to have more consumers. Maybe you have someone that you're trading for and you're also lending to at the same time. So that's what he means by capital. They're basically dedicating the resources because they're recognizing that if there was another important point that Moynihan made where he said, if they can show that they can deploy this and make money, we'll give them more money. So it's like you eat what you kill, or maybe that's a terrible phrase for what I'm trying to get across. But if they're going to show Moynihan that they're performing each quarter, and they have, then there's more room for them. There's more resources that they will get to hopefully continue that growth. Now, if that growth stalls or they're losing money at a point, they might have to reevaluate and reassess. But at the moment, he's saying this is a pretty big and good bet for us.
So, Kat, very briefly, 2024, what does that look like? I mean, we have no idea what the volatility is going to look like, but what's an expectation that these employees have?
Well, after bonus season, I think the big question mark will be how is the economy going to respond to the Fed cutting rates, if they do, when they do. There's a lot of bets that folks will be making around the timing of that. And so traders will be there to say, hey, we're here whenever you want to reassess, what have you. If deals come back, that's really good for investment bankers. So investment bankers are sitting there saying, we want this period that everyone is talking about to finally thaw, finally open so that we can get back to work. I think those are the two parameters that I say people are watching.
Yeah, a lot of
forward.
folks certainly hoping for an unthawing of the IPO market, so
Absolutely.
we start to see some deals. Hey, Hannah, I want to talk to you a little bit about your JP Morgan story that came out this week about succession after Jamie Dimon. He's kind of famous for always saying 5 more years. And when he's asked about the succession question, he is the only CEO of one of the big banks who actually was there during the financial crisis and steered the bank through the financial crisis at the helm of the bank. Who's in line for succession, and what are you learning?
Yeah, so that's a great question. So Jamie Dimon, has been in his role longer than any of the other major Wall Street CEOs, and he's rounding out his 18th year at the top. He's really, built JP Morgan into what it is today. And he has long joked 5 more years, no matter when he's asked. And that got, a little more serious in 2021 when he was given, a special incentive to stay until at least 2026. And around the same time, they had their biggest management shuffle, in years that really added some clarity to the succession picture there. So you have Daniel Pinto, who's the sole president of the firm, and they've made it really clear that he's, there in case of an emergency or some sort of accelerated handoff. He already served as, co-head of the firm on an interim basis when Jamie had a health issue in 2020. And so he's there, he's president of the firm. And then the two people that were really thrown into the spotlight in a new way in 2021 were Marianne Lake and Jen Piepzak, and they co-lead the consumer, the massive consumer arm together. And those are the two that, people would really consider to be the front runners. Although as time passes, this JP Morgan succession question has been going on longer than, I've been on the beat, longer than I've been at Bloomberg. It's a forever question so far, and so we've seen this before where people come in and people make their way off of that list for some reason.
And he certainly doesn't seem to be slowing down at all when you see his interviews or when you see the way that he's in front of Congress.
Totally.
Yeah. We'll have to wait and see. Great reporting from both of you.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
I mean, who doesn't want to be forever young? For thousands of years, finding the so-called fountain of youth has really only been the stuff of legend and fairy tales. And Silicon Valley, more than anywhere else, has for decades been, hoping not only to slow aging, but also to find an actual cure for death. This goal has made the region and its technophiles the butt of many jokes and the target of criticism. I mean, just think back to the Blood Boys who provided their blood to Gavin Belson in the HBO show Silicon Valley a few years ago. But there's some serious money going into anti-aging startups in the Valley. Among them, Retro Biosciences, a startup with $180 million from none other than OpenAI's Sam Altman. The company has a simple and audacious goal: add 10 good years to your life. And until now, we haven't actually had a glimpse inside of Retro Biosciences. But thanks to Ashlee, Vance, features writer for Bloomberg Businessweek, now we do. He writes about the company in the forthcoming issue of Businessweek magazine. You can read the story now on the Bloomberg and at bloomberg.com/businessweek. Ashlee, also the author of Elon Musk, Tesla, SpaceX, and the Quest for a Fantastic Future, as well as his newer book, When the Heavens Went on Sale, The Misfits and Geniuses Racing to Put Space Within Reach. You also know him from Hello World on BTV and on Bloomberg Originals. Joel Weber is the editor of Bloomberg Businessweek. He joins us here in the Bloomberg Interactive Brokers studio. Joel, this story is part of the longevity issue. I'm obsessed with longevity, not just because I would like to live longer.
Yeah, you're not alone, though.
Yeah, I'm not alone.
Also, just want to give Ashlee a shout out because...
Did I not read everything that he's done?
I was going to say,
okay, what else?
Editor of Bloomberg Businessweek, quite short. You think about Ashlee's accomplishments, quite long.
He's a tough act to follow.
Well, I will also say, Ashlee was something of the inspiration for this issue because we did this story earlier in this year, how to spend $1 million to be 18 again. And man, that story went viral.
That story did well.
Brian Johnson, just that name, I think we really put on the map, and that was all thanks to Ashlee, which that was not even the first Brian Johnson story that we had done, and it won't also be the only one that we talked about this week. But Ashlee has just had his finger on the pulse of Silicon Valley for everything, forever. And what we appreciated was that Silicon Valley is obsessed with this puzzle of how do we live longer, how do we live better as we age. There's some very interesting individuals who have novel approaches to that. There's also just like people who have a lot of money and are willing to throw it at the problem and see where that ends up. So we started talking about this issue kind of earlier in the year, and we just started to try and figure out the stories that we wanted to do. And this began as like an open invite to Ashlee. There are a number of labs obsessed with longevity. Ashlee, tell us about the one that we decided to feature.
Yeah, well, thank you guys for all the kind words. This is Retro Bio, like you guys said. It's funded by Sam Altman.
Perhaps you know that name.
Yes.
He ruined a lot of weekends for Ashlee recently.
But Retro is one. What we point out in the story that I think is particularly interesting in the field of longevity is the science kind of comes and goes that people get excited about, but there's a thing called cellular reprogramming, which is the current, as far as like real longevity science goes. It's sort of what people are most excited about. Retro is one of a handful of companies that have received hundreds of millions, in some cases billions of dollars to further this technology. And it's basically about taking the cells in your body, hitting them with proteins or small molecules and taking the cells back to a younger, healthier state. It's stuff that we know we can do in animals, and now we're trying to find out if we can do this safely in humans. And Retro is one of these companies going after this.
What does that actually look like, and how much money do you need to do this? Because there are labs, longevity centers, who have a lot more money than what Retro's actually has, even though they have a lot of money too.
Yeah, I mean they have $180 million. They're weird because they're chasing 5 different types of longevity technology at the same time. The table stakes here appear to be at least $100 million. There's a company called Altos Labs that's backed by Jeff Bezos and Yuri Milner. They have $3 billion, and so there's something of a race going on where, again, we've for about 15 years, maybe even a little more, we've done all these experiments on animals where you essentially take one of their old cells. You can take a skin cell off of a mouse and you can revert that all the way back to a stem cell, kind of that blank slate where all life begins, and then advance it again and create a whole new animal. In this case, we want to take something like a liver cell that has its identity as a liver cell, and we want to reverse it, but not to that blank slate. We want to just reverse it back to a healthier liver cell. And this is sort of the trick that everyone's trying to figure out.
Emily, you're going to have to pick a horse. $180 million with Sam Altman, $3 billion with Jeff Bezos. Go. Which one do you pick?
I'm going to go with Bezos.
Oh, okay. Well, that was the wrong answer, but
oh no! I just picked the more money, honestly.
Yeah,
it might be right. It might be right.
Well, who knows, right? But okay, so walk us through this partial cell reprogramming, Ashlee, and what does that actually mean? Because that's the thing about longevity, you start like getting into the space, and all of a sudden there's this whole other world of vocabulary that no one's ever familiar with. So what does that actually mean, and can I do it now?
Yeah, okay, I'm going to nerd out on everyone for a second, but around 2006, a Japanese researcher, a doctor named Yamanaka, he discovered that there were these, they call them transcription factors. They're basically proteins. They're present in our body. We have between 1,500 and 2,000 transcription factors in our body that perform various functions. But he discovered you could take a cell from a mouse and hit it with these 4 transcription factors that sort of turned on some of the genes that are present in our youngest state when we're closest to a stem cell. And those cells would, in fact, start reverting back to their stem cell state. And so at the beginning, people just thought, oh, this is interesting. Stem cells were very controversial. You had to, harvest them from embryos, and this was now a way to manufacture stem cells artificially. And then in 2016, another researcher named Alex Ocampo, he was the one who discovered in mice, again, that if you finessed this process just right and you didn't turn these genes on all the time, you just turned them on for a couple of days, that the mice suddenly started living 30% longer than all of their peers. And this is when the longevity field got excited about this technology.
Tell us about the founder, Joe Betts LaCroix. I think I'm saying that.
Yeah. He's a character and a half. He grew up in Oregon with these kind of counterculture parents during the 60s. He's got a very unconventional background. He had a D average in high school and then somehow got into Harvard, from what he says. It was a very creative essay and transfer application from a community college. And he's had this interesting career. He's been a serial entrepreneur in Silicon Valley. He's been an angel investor tied to Y Combinator, and he's done a number of startups over the years. Some of the older people listening will remember OQO. They made this tiny computer that caught everyone's attention around the 2000s, and he's an autodidact who is not a trained biologist or anything like it, but he got interested in the longevity field and learned all of this science and then put this team together. The thing that stands out about Retro is that it's a very unconventional biotech firm. All their mice live in these shipping containers that Joe and a handful of people built by hand inside of this retail building. This is not like your standard laboratory, and they built the whole air filtration system, the HVAC system, everything by hand.
Hey, Ashlee, you've done a good portion of reporting this year, and gosh, even last year, on folks who are looking into anti-aging, folks who are trying to reverse aging, folks who are trying to add good years to life. Brian Johnson's documenting this on Twitter now quite a bit. Based on your reporting, and I'm just curious if you think within our lifetimes, we are actually going to be able to take advantage of this type of technology.
I mean, you look at what Brian's doing. He's basically testing every single substance that's ever been in a paper that's shown some sort of benefit for longevity. And there's interesting things there. There's people doing stuff like autophagy, which is basically calorie restriction, which a lot of people have heard of, where your body seems to repair itself. All those things, are real and seem to contribute in different ways. But it's this cell reprogramming stuff that really seems to have the most promise, and that really did get me excited. If you talk to the researchers in this field, they will tell you what I said, that we've seen this work in animals. That what happens is sometimes when this process gets overactivated, it causes your body to grow tumors all over the body. And so this is why we have not tried this in humans.
That's not good.
That's not good. If we can figure this out, it's a huge if, but if we can figure this out, and all these scientists really think this is like an engineering problem, they think the science is solved. Yes, I think, this is the most encouraged I've been by anything in a long time. And you have incredibly smart people and tons of money being thrown at this, and it's our best bet.
Okay, so what does 10 years look like then? Like, what do I have to do to get 10 more years?
Well,
minus the tumors, please.
I would like 26. I would like 26 to 36. Those are the years that I would like. Okay.
Can we pick them like that, Ashlee?
Yeah,
No,
those are the years I want back.
When you talk to these researchers, the way this is probably, if it works, the way this is probably going to play out first is that somebody would come in with liver disease, and you would repair the liver, or you would have heart problems and you would repair the heart, and it would be this kind of like organ by organ basis where you're fixing pretty severe problems. The promise is this more like generalized use of this technology where you really would repair the entire body and all the cells within it. I mean, that is far off, but like I've asked these people, I'm like, so you're telling me I'm going to get an injection and then my face is going to like revert back to my 25-year-old face, and they will tell you quite point blank that yes, that is kind of the goal, that over a period of months, that is what would happen to you.
I mean, I care less about like, I guess, reversing the aging process from a physical perspective, like looks, and more like feeling. Like I don't want to be sore anymore. I want to be able to just go on a ski trip and not train for it. Yeah. You know what I mean? Like things you could do when you were like a lot younger, and that was totally fine.
I can't wait to hear how this plays out for you.
Here's the problem.
I have to train for
Here's
a ski
the problem.
trip.
I'm not a billionaire, okay? That's the problem. I have no blood boys.
Put the shot right here.
I have 0 blood boys.
Put the shot right here.
Yeah.
Okay, Ashlee, what about the competition, right? We mentioned $3 billion in Bezos. What's the approach? What are the different approaches that kind of round out this field? If Retro's got this way, how are other people going to go about solving it?
Yeah, so Retro's kind of doing all these experiments on these mice. They have tens of thousands of mice. Altos Labs, the company backed by Bezos and Milner, what they've essentially done is hired the whole world's top academics in this field away from their university positions and given them money and their own laboratories and been like, let's see how fast you can run. And if you don't have to, teach and write papers and all that. And so that's another approach. There's a company called New Limit, which is funded by the Coinbase founder, Brian Armstrong. They are essentially I talked about those transcription factors, those 4 proteins that have unlocked this process so far. They're doing a massive study of all 2,000 transcription factors, essentially a huge computing project where they take these samples and they analyze them, and then they're trying to find the best combination of these factors that will affect the body. And so everybody's coming at this from like a slightly different angle, and it's just not clear which approach will be first. I'm actually kind of shocked. There's really not that many startups beyond those 3. I mean, you can argue pretty easily that this could be the best business of all time. I'm sort of surprised there's not 20, 30, 40, 50 startups in the space.
Well, there's still time.
And there's also still time to check out this story on the Bloomberg Terminal. It's going to be available in the upcoming new issue of Bloomberg Businessweek on newsstands later this week, already online at bloomberg.com/businessweek, and of course on the Bloomberg Terminal. A big thank you to Ashlee Vance. He is features writer for Bloomberg Businessweek. And also a big thank you to Joel Weber, the editor of Bloomberg Businessweek. Joel, we're going to start to hear more from you on the longevity stuff, right?
We can talk more tomorrow.
Okay, cool. All right, that's
people
a nice
call my
tease.
people. We'll see about it.
A nice deep tease for tomorrow. You're listening and watching Bloomberg Businessweek.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.